I would expect really in the next years, something like ways to work with the data will not lead to, oh yeah, I get more exclusion to it, but something like I'm more aware of the risk and I can manage them better and have better offers out there for the clients.
You're listening to Rethinking Insurance, a podcast series from WTW where we discuss the issues facing P&C, life, and composite insurers around the globe, as well as exploring the latest tools, techniques, and innovations that will help you rethink insurance.
Hello and welcome to Rethinking Insurance. My name is Sina Thieme, and today I'm delighted to be joined by Frank Schepers, who leads WTW's insurance consulting and technology business.
Good morning, Sina. Happy to be on the podcast. It's my first podcast. I think I spent countless hours listening to podcasts, but it's the first I do myself. So I'm quite a bit nervous.
Excellent. No, I've seen you jumping around various insurtech conferences more recently. So I think it would be great to get your feel on how technology in particular and sort of software developments impact the insurance industry and impact the way we do business. And obviously there's lots of different angles to that. So maybe we can start with sort of what technology would do to enhance risk modeling and how it would change the way we are able to analyze risk.
Wow. That always goes deep into something like the context. Let me start. I mean, first thing I want to make clear, when I listen to podcasts and people say, oh, I give advice to the entire world, I'm thinking, well, why do these people think they have the right to tell everybody how to do things? So I'm not telling insurance companies or let's say the managers of that how to run their company, because I'm not running an insurance company. What I'm running is probably the biggest team of consulting actuaries and the biggest insurance technology in our space. Always depends on how we define that. And in that sense, a bit like I can talk about how we go about what do we think we need to do for our technology so it becomes of more value to our clients to enhance their business. And I think that's what I want to focus on.
Good. So how do you think technology has played into that in the last years?
Yeah, interesting. If we talk the last years, probably we have to talk about, well, what happens up to when Gen AI took off AI, because I think that's at the moment is the big question. Yeah, when people said, oh yeah, what's the latest thing on that? At that InsurTech conference, for example, I was something like honored to speak on the main stage. And at the stage, there was a purple stage, just the room next door to it. And before I had my session, there was a session about, I think it was Hiscox transforming their underwriting cycle. And they're going from, don't know, months into seconds, something like that. And the room was crowded. Everybody was interested in that. And I had then a session next door talking about more in general how it is influenced. I think at the moment, a lot of hype is about how can you make things faster, more efficient. Data ingestion is a big point. Yeah? So how do you get all the data sources together in order to do things? What we do as a company more starts after you have all the data in. So we are very interested about how you can make better pricing decisions, better underwriting decisions, handle your claims better. But really thinking about that, what is the clever algorithm, how to do that?
So I agree. I think that's one part of it. But I guess the other part that we are pretty strong at is actually identifying which data items are relevant and could be relevant in the future, right? Because that's the key. I think you mentioned multiple times in other conferences before that people are always complaining they don't have the data. But it's not just going to appear if you don't do anything about it, right? So understanding what you need to start collecting so that you're in a better place in 10 years' time, I think, is something that, it is in our strong suite as well.
Yeah, but I think in 10 years' time, I'm not sure whether all the insurers have time to wait for 10 years to do that. I think they need to start almost immediately. There was also a question on the same InsurTech conference about will then also something like the brokers wake up to that, and will the insurers play with them? I think it's just reality is like we're going to a digital marketplace. Yeah, so we need to really leverage what is there in terms of capabilities, and if you say, well, we don't have the data yet, then you need to think about, okay, but which data do we have? How can we use that? How can we structure that? What are data sources we can get externally also, augment that? Maybe that's the first thing. Is about like thinking about how we can get there is a bit like, well, how can you start? I think is more the relevant question to it.
Yeah. And so do you see our understanding of risk just sort of exponentially increasing the more data we get, or what sort of challenges are there?
I would turn around. I think it's with new technology, new methods to use the data which is there. Again, data ingestions, not an expert in that, but it's a bit like you need to have that. And once you have that, I think then you can apply lots of these clever thoughts, algorithms that we are building to really make use of that. And I would say it's a bit like, without that clever thinking at the back end, why should you collect data in the first place if you don't use it? But also flip it around, if you don't have the data, you can't do the clever maths and decisions at the back end. Yeah.
And I think that's where AI is actually quite interesting as well, in terms of sort of recognizing patterns where humans wouldn't expect any patterns or dependencies, or so understanding sort of which characteristics are actually relevant for defining a risk, or which characteristics increase or decrease risk. I think there's this example of like thousands of people being asked by NASA to basically look at solar system pictures and identifying various constellations of stars and stuff. And so it's a real team effort. You give that to AI, and it basically sees stuff that the people didn't see because they were looking for squares or something at circles rather than like triangles.
Yeah.
So like just being able to identify stuff without knowing what you're looking for, I think that's interesting, and I think that will really have an impact on sort of identifying risk drivers as well.
Yeah, and it's as much about when we talk about identifying risk drivers. So the actuary in me, deep inside of me, and the risk manager tells me, oh, I need to see more risks. Have I thought about this risk? What happens now is that all the insurers are aware that there are risks out there. And for certain lines of business, they say, well, there are big risks out there. I'm not really sure what there are. I don't have complete data. So what do I do? Well, I need to build in some security margin on that. Need to have a buffer. And then you have a buffer on the buffer, which then ultimately leads to saying, okay, because I don't really understand the risks, I don't have the full data for it, either I price myself up to a level where nobody wants to trade anymore, or I said, well, because I don't have the data, I can't write that risk. And I think that's a bit like, one of the big themes that we have as a company, we want to close, or let's say reduce the insurance gap. We want to bring more risk to the market in order then, let's say, for our corporate clients, then to say, well, you can insure more what you have on better conditions. And this, I think this is really, the more you understand about the risk, the more you're able also to price it then really efficiently. And something like reduce maybe also some of these security buffers over it. I think that's a big thing. I would expect really in the next years that something like ways to work with the data will not lead to, oh yeah, I get more exclusion to it, but something like I'm more aware of the risk and I can manage them better and have better offers out there for the clients.
And I think insurers understanding the risks better also allows them to actually communicate those risks to policyholders better, right? So I was at a risk pooling event last week, and the risk pool is trying to make themselves basically irrelevant in the next 15 years by sort of shifting all of the risks back to policyholders who are being asked to mitigate them, but also the private insurance industry. And so it's a lot about actually telling policyholders, if you do X, Y, that, then you're going to reduce your risk on average by X, right? If you install these flood-proof doors, then this is what happens. So I think this whole concept around awareness of your risk and mitigation techniques, I think that increases as well for policyholders, not just insurers.
Yeah. Although also here by way of introduction, I'm a life actuary, have to admit that as well, yeah. Also in life insurance, we say, okay, why can't we put the risk back to the policyholder? I don't like that. It's a bit like, well, the insurers, where they have certain the disability risk, being something like out of the job. They got a retirement risk, something like how do I make up for my living when I got older, I'm out of work with that. Something like if I'm if something very dreadful happens to me, something like who's looking after my family, all of that. All of these are risks I would not place to the policyholder. It's a bit like also that when you go to retirement, and I'm coming nearer that age, it's a bit like, well, there's an inflation risk. The much I can save up to now, if there's something else. I mean, we've seen capital markets just last week. We're recording that at the end of April. You see markets swinging up and down. Yeah, if I would be sitting on these assets and I got all of these swings in my own something like pension money, I would be quite scared. What happens to it? So I really want also others to take on that risk for me as a service. Yeah.
Yeah, I think that makes total sense on a life insurance side. I think there's more sort of examples on the P&C side where actually with a few quite simple mitigation techniques you reduce your risk quite
absolutely. I think with all of the risks, it's a bit like we should put protection, something like mitigation, make sure the risks are not coming in. We should help really something like the client who owns the risk in the first place. We should help them something like to manage the risk, and then what is remaining for that, we should have an answer as an industry.
Yeah, that makes sense. And I think, the other sort of protection gap that exists is in form of stuff that is just currently not insured, where I'm talking about intangible assets, for example, right? So anything around intellectual property, brand value, that sort of stuff. It's funny that insurance is still very focused on hard assets, but there's actually a lot of value in the word that it isn't covered in that sense.
Yeah, that brings me. Well, I'm not an expert on many things. Yeah, but I'm not a cyber expert. But I'm thinking also, well, you get cyber insurance. What is it protecting for? It's protecting for, okay, you got a cyber attack, and then something like your business is out of business for a week, business interruption. You can insure that, fine. But what is really something like you're talking about IP rights? So you're building a company, you develop something, and then somebody just takes it away. There is one thing where you say, well, you can insure probably somebody coming in and stealing that from you or copying whatever, yeah. But the other risk is also just by the way how things are developing, something like that. Your knowledge becomes a bit like, well, common sense. It's a bit like you thought you had a secret source, and then, a week after that, somebody comes in. Yeah, a bit like what we saw also with something like the AI. You got ChatGPT and you got the new stuff coming around, which says, well, okay, whatever you did, I can do it in a week and much quicker than you did. So, but this goes into what is insurable, which is, I think, a big topic. And I'm not sure we can go through the grounds.
Cover that in 2 minutes?
No.
And I guess the other angle on like technological advances are around distribution channels, right? So I think you travel the world and probably come across quite interesting concepts of how to get people onto insurance by making it basically more accessible to people and less of a sort of myth. So I don't know if you have any examples of where you think this works well.
Yeah, that's a bit my Indian experience. Always, I've been to India and it's always a bit like, well, that big impression for me is like, well, how can we make sure we ensure that other billion, underwriting by, using a smartphone to stuff, make it accessible. Also, that doesn't solve then still affordability. That doesn't solve, okay, I can now reach all the people and in theory they can access it and they can buy it, but can they really afford it? Do we also have something like then the propositions for them to buy into that? Yeah, so I think it's a bigger thing than just, we have a platform and then it works. We've seen so many platforms, but then nobody's using them because the driver's not there.
Yeah. And so I guess this is sort of the insurance risk side on the balance sheet. On the other side, we've got capital that needs to be held against that risk. And I guess a big sort of thing that WTW feels strongly about is actually bringing that capital closer to risk. What does that mean for you, and what does that mean for our insurance consulting and technology business?
Yeah, I think, well, as I said before, that ability to have more information, price risk better, means also something like you can also manage the capital. You need to deploy less capital against the risk, the better you understand them. And you may also find out that there are certain risks. I would say for every risk, there's a perfect owner for that. It's a bit like, comes back to risk appetite. It's like when we look at the big continental European insurers, they all shied away from guaranteed business. Come back to the life side again, because they said, well, we don't want to have, the big capital sitting against to it. And then the question is, okay, do you give that back also policyholders? Somebody don't do it. Or do you carve out? We see some recent transactions also in Germany also where you got then all traditional insurers also getting their way back into these kinds of businesses again, backing up the capital. Also then partnering, I think that also goes into, we see ecosystem, we talk about ecosystems, and we come back to that probably in a bit, like how do different suppliers of technology consulting play together. The other one is also how different, something like private equity, traditional insurers, how does that work together? I mean, you're something like, can I say Mrs. ILS for us? You work in Bermuda on all of that. So what's your experience?
I think that's exactly what we're seeing, particularly on the cat bond side at the moment. Q1 has been as busy as never before, which means more investors, so pension funds, family offices, hedge funds, are interested in taking on insurance risk in some form, and having that as just a diversifier to other asset classes. And if you just look at how much assets are under management by exactly those players, that provides a ridiculous amount of capacity to the insurance industry. There are certain barriers, such as the fact that risk needs to be modelable, and obviously certain types of particularly secondary perils, like hail or whatever, that's actually very hard to model. So some types of risks are just not naturally fitted for sort of this insurance risk asset class. But actually there's a lot of appetite that we're seeing, very exciting. Investors are also very interested in looking at non-property cat risks, so trying to work out how you can transfer casualty risk despite its long loss development. That's sort of the challenge that currently exists. So then you're thinking about like runoff players actually taking those portfolios on after a certain amount of time. So I think it's great to see how like different parties interact and actually take risks at different layers, at different points in time. And that's probably what you were referring to when you said ecosystem as well. Like it all sort of
absolutely.
plays together.
Absolutely. And you have to assume that all of that capital is smart capital. So again, it's also, so what can we as a company bring to them? So we can not only help insurers with that, we can also help them, let's say, that capital, which is then private equity, whatever, to understand risk better. So like what they buy. And I think they are typically very clever.
So I guess with all of these changes that we've been seeing, how are you setting up insurance consulting and technology as a business to sort of respond to those changing client demands?
Yeah, well, maybe going one step backwards, because, well, we got a very popular podcast, which you are hosting for countless times. But it's a bit like, I mean, for those who are listening to it for the first time, insurance consulting and technology is what it says on the tin. So we have a business which provides a combination of technology solutions and also then consulting advice to combine that in order to help insurers almost exclusively, but with the exception we just talked about, something like to run their business better. So that means for us is also when we think about it saying, okay, if we think about, well, how can we improve what we bring to our clients? We have to think about how can we give better advice and how can we improve our technology? And that is quite a long way away from where we started as a company. So I'm in that company for almost 31 years now. Glad we're not on video today, just on audio. When I started off, it was also a bit like we also have been a traditional actuarial consulting business. So this is what we did, very traditional. And if I see how much we have changed over recent years, probably the last decade, and we're accelerating that, is a bit like going a lot more into what is technology we're offering. Because we say, well, that model where we just say, well, we got clever people doing clever stuff, I think that's the business model. Well, you can have clever ideas, but if you can also then encapsulate them in technology, so make them really available to many players in the market, leverage that, that's the big thing. And I think that is really where we're focusing on, trying to get how can we improve our technology in order, one, something like to equip our consultants then to help their clients to make business better.
Yeah, and I think you quite often also say, let's focus on understanding the problem first and what the solution is, and technology is almost always the answer. But basically knowing what value you would be getting, what problem you're trying to solve with the software.
Yeah, absolutely. And going back to data ingestion is a bit like what we are bringing to the table is, I would say, often almost, yeah, so one of those, is a part of the solution to it. Yeah, it's a bit like we're going in, we can help, underwriting workbench, make clever decisions. And in that workbench, you have a pricing built in, and you got the capital model built in. This is all fine, but that doesn't work unless you got data ingestions and data strategy at the start. And that doesn't work if you don't then report it and you got the right actions triggered to it. That doesn't work if you don't have the right management structure to put that into play. Yeah, so this is also why, and maybe that's a bit of marketing in between. It's a bit like when we look at our pricing software. This started really off as something very actuarial, the kernel, how do I do a GLM pricing for a risk? Yeah, mathematical model, same I did at university 35 years ago. Yeah, a bit like, yeah, you can look at that, fine. And then we went one step further to say, okay, you got elasticity curves and something like if you change your price, how will the market react? Okay, that's the next step. We did that 20 years ago. Then we went into, okay, now we can also deploy that. That's the rate of life thing. It's a bit like it's great that you're clever pricing. If you don't bring it to the market quickly enough, it's not good. And then the next thing, and now I'm talking about India, and I was in Tokyo a month ago. Oh, that was great as well. We had a client meeting, and my expectations, don't have to apologize for that because I'm a German guy. I went to Japan. I think, oh yes, we have some friendly meetings and there are not a lot of topics discussed and all of that. I was so wrong. It's a bit like we went into that and they say, well, yeah, actually, we got some subsidiaries who work in these countries, and in that country we're proud. We're always 5 percentage points better than the market. And I say, well, how can you have a systematic something like advantage over the market by 5 percentage points? And they say, yeah, one is we are better to something like analyze the risk, price the risk. We know the market. And he said, and then the magic thing is then also if we see something happen in the market, we can react to it, react quickly. And I was thinking, oh my God, that could be the perfect salesperson for us, because that is really the latest thing we've done that for the radar, something like analysis, deployment, but then also the monitoring. Has the world changed? Yeah, what have we seen? A bit like something like there was, I think some years ago in the UK, say something like, I think BMWs got stolen, something like more often than other cars. And then the question is, okay, how quick are you to react in the market? And I think that's really something like the whole thing. And I think this is really where we're investing in to say it's not only about mathematics, it's not only about deployment, but also linking that to the management actions.
Yeah, and so that's also pretty impressive if you think about like standard reporting cycles here. You would tend to only pick stuff up like this a half a year later, once you've actually looked at, your semi-annual dashboards or whatever.
Yeah.
So it's great that seems to be a very frequent monitoring system in addition to actually knowing what to do once you've identified a problem.
Yeah, but I think it's not commonly used. I mean, also at the InsurTech conference, there was also a very prestigious company reporting what they're doing and the platform and everything, and then say, our pricing models got updating every 3 months. And I was thinking, every 3 months? I was thinking, oh, they can use our software for that. It's like, yeah, it's something like more frequent, but also depends on the market, of course. Something like if you go to UK motor market, highly sophisticated, extremely efficient, something like aggregator platforms around that, you need to be able to react very quickly. And then we talked earlier about the other risk, where you said at the moment we don't really know how to trade these risks and if at all. I think this is less of a thing. So you also got something like that, a maturity curve probably also by risk you have to go through.
Yeah. And so that agility that you're talking about, I guess we need that within our own teams as well, right? So how are you ensuring there is enough agility, enough room for innovation within our business?
Oh, yeah. So you speak now, maybe also again as context, I said we are in our line of business about 1,700 people, of which probably 1,000 are actuaries. Yeah, and actuaries are typically those who are, say, known for being, very active, proactive, getting new ideas. Well, I think we can be proud to say that the actuaries that we have, of course, are those who are much, much quicker in their thinking and the deployment of that. But still, there is a bit like that legacy where you say, but we have done that always like that, how we can break that. For us, for example, one of the big things, which also I think sets us apart from other competitors in the space, is a bit like we're running a global business. So when I started off as a global leader, one of my big things was to say, I don't want us to have, America's region, European region, Asian region. They all run the business, and then at the end of the year, we sum up all the numbers, and then we got the results. I said, no. I want to, we're also working for really some of the biggest insurers globally, and I want to make sure they get the best service and they get the best people wherever they are. So if we got an opportunity, something like in Asia, we need to make sure, something like that, we get the best people for that problem working on that. Yeah. That's a bit like, this is overcoming things like where some companies are really, they got local P&Ls and they got local structures and all of that. We say, well, I'm not interested in that. Yeah, it's a bit like at the end of the day, we are one business, and we say something like, if you get one of us, you get all of us. This is really what we aspire to. And I think it also, I can say, it has not been easy. Something like now 3 years in a row. And it's like in the first year I said, we want to do that. People say, yeah, fine. Second, so I said, I want to do that. And they say, we're doing some of it. And I think this year, it was really, really taking off. So I'm really, really proud of that.
Yeah, and that's definitely something that has kept me for this long at WTW, right? Because it's great to have this global network. And so one example, for example, is I'm working on a German cat bond. They are actually taking on risk from a Japanese insurer. The special purpose vehicle for the Japanese insurer, who also issued a cat bond, sits in Singapore. And I'm obviously in the UK, so we've got Germany, Singapore, Japan, and the UK being involved. And I'm very easily able to put together a team of exactly those regions, and we work on the same project with no issues. And that's pretty, 4 regions for a small project is quite an extreme, but that's how I grew up, right? And that's sort of how we train our people to be, which is pretty amazing.
Yeah, no, I think that it is very important. I think it's at the moment we see many factors leading towards, something like the globalization goes back again. I don't think it will. I think we got a globally connected world, and I really want to live in that. Yeah.
Great. On that note, Frank, thank you very much for joining me.
You're welcome.
And if you're interested in other episodes of Rethinking Insurance, then please go to our website and have a listen.
Thank you very much.
Thank you for joining us for this WTW podcast featuring the latest perspectives on the intersection of people, capital, and risk. For more information, visit the Insights section of WTWCO.com. This podcast is for general discussion and/or information only, is not intended to be relied upon, and action based on or in connection with anything contained herein should not be taken without first obtaining specific advice from a suitably qualified professional.